Good evening, class, and welcome to our advanced taxation class this evening. We are still discussing oil and gas taxation, and in the last class, we have been solving past questions from ICANN. We have looked at question number one in 2019. We have looked at question number six on November 2016, and May 2017 question number 7. Let's see how much more PPT questions we can solve. Okay, so let's go to another question, which is question number 5, May 2018 question number 5. So let's get it open. May 2018 question number 5. It's going to open up in the moment. May 2018 question number 5. All right, so this is the question here. May 2018 question number 5. We are going to be looking just the calculation part, which is 5B. So let us go straight to this question with time. Past May 2018 question number 5B. This is what we are taking right now. May 2015 question number 5B. So let's look at the name of the company, Ayokunle Nigeria Limited. So let's take it. Ayokunle Nigeria Limited. That's the name of the question. Now let's see something here. Ayokunle Nigeria Limited engages in petroleum operations. So this shows it that it is an upstream business. The company was incorporated in 2005, but commenced business in January 2010. Now, we are not interested in when it is commencing or when it operates or when it commences business. Where we are interested here is the activities for the year ended December 31, 2016. And so with that, this is year of assessment 2016. Now we usually do something here. We usually say 2016 minus 4 gives us 2012. So what it means that for the year 2012, we are going to be losing 19% for our capital allowance, annual allowance, 19%. So 2013, 2014, 2015, 2016 will be 20%. Now, this is only going to hold true if this is a capital allowance, if this is a joint venture. So now let's look at this question if it is a joint venture or a PSC. It says here it operates in the continental shelf at water depth of 155 meters. So this is a joint venture, not a PSC. A PSC goes deep down more than 200 meters. And now because it is going at a shelf water depth of 155 meters, it shows that it is not going deep. It is kind of a shallow compared to PSC. And so we have looked at how we know that it's a JV company. So let's read on. Sale of crude oil. These are activities for the year. Sale of crude oil. We have exports. This is the dollar amount per barrel. This is the number of barrels. The domestic amount is in naira. Of course, because they have given us this in dollars, we are going to be seeing the dollar exchange rates so that we can convert this into naira. Now look at chargeable natural gas sold is 300 million 800. That's fine. This is other income from other sources. We are yet to see other information to clarify income from other sources. If there's anything that is going to be disallowed from here, we'll keep our fingers crossed. Look at all the expenses incurred. Uh-huh. Then the following information was provided on the above statement. Capital allowance was given, plant and storage tank. Okay, this is the plant and storage tank used during the year. So there is no plant and storage tank here. Okay, so this is capital qualifying capital expenditure. This is the cost. So this is what we use to calculate your PIA, and this is depreciation. Of course, depreciation was not here, and we are told that depreciation was included in operating costs. So it means that we're going to um, check operating costs. Then custom duty on storage tank was included in miscellaneous expense. We are going to remove this storage custom duty on plant and storage tank. We are going to remove it from miscellaneous expenses. Custom 70% custom duty was on essential item. So when we look at custom duty, 70% of this was an essential item. That is what we are going to take as our allowable. Then look at the average exchange rate during the period. This is the 365 to $1. So we are asked to look at all of these. So accessible, chargeable, profit, and chargeable tax, 15 marks. So let's get that mark right now. We are asked to look for accessible and chargeable profits and chargeable, take this off here, chargeable tax for year of assessment 2016. So that is it. We'll put our 2 naira sign here, 2 naira sign. I'm going to be using everything. I'm going to be putting the whole figure. I'm going to be putting the whole figure. It might be too much. I'm going to put 3 naira sign. So let me use 3 naira sign. 3 naira sign. Okay, so that's it. So what do we do now? We start with the income. Income. So we have export sales, and our export sales is going to be how many barrels? 120, 500, 120, 500 barrels at $52. 120, 500 at $52. 120, 500 barrels at $52 multiplied by what is the exchange rate? The exchange rate here happens to be 365 to $1. So all the ones I've used, I'm going to tick them out. I've used this, I've used this, so that I will not miss anything. So times 365. Now I'm having a problem with my on-screen calculator. So you won't be seeing the calculator here, but I'll be telling you what I'm doing. So 120, 500 multiplied by 52 multiplied by 365 is giving us 2,287,090,000. So I'm going to remove three zeros. So it's going to look like 2,287,090. Of course, these three zeros is not included. So that's my export sales. Then this is local sales. Now my local sales happen to be 70,000 barrels, 12,250 per barrel. 70,000, 12,250. All right, so let's calculate again. 70,000. If you have your calculator too, you can be checking so that we'll be doing them together. Times 12,250. That will give us 857,500. 857,500. Now that's local sales. So the next one here, we'll be looking at chargeable natural gas. So it's going to be 300, 800. So this is chargeable natural 300, 8 of that. Then income from other sources. We're not told anything about income from other sources. So we take it, it's an allowable thing. 6770. Income from other sources. So that should be 6770. So if we were to add everything together, so we have 2,287,090 plus 857,500 plus 300, 800 plus 6770. That will give me 3,452,160. So it's going to be 3,452,160. So this happens to be gross income. So gross income is here. Now we are going to remove less allowable deductions. So some people might say section 10 allowable deductions. What are these deductions? We'll start with the additional information. Capital allowance will come later. Plant and storage tank will come later. Depreciation of 105,000 was included in operating costs. So let's go to the operating cost and start doing it. Operating cost is 523,750. 523,750. Operating costs 523,750. That is what we have here. So we have used this. Then, okay, I'm going to be tracing it like this. Then we are going to remove this depreciation of 105,000. So remove 105,000. So how much would that be? That would be 523,750 minus 105,000. That would give us 418,750. So that would be 418,750. So that's your operating cost here. Then the next one here is custom duty on plants and storage tank of 2,250,000 was included in miscellaneous expenses. So we are going to come to miscellaneous expenses, and that's the next thing we are going to do. So miscellaneous expenses is what we are going to do. 32,170. See the systematic way I'm following this thing. Miscellaneous 32,170. Okay, so we've taken this. Then we are going to remove this whole money here. That 2,250. 2,250. We are going to remove 2,250. So we'll say minus 2,250. So what would that be? 32,170 minus 2,250. That gives us 29,920. 29,920. So that's done. So we have used this. Now we are not saying the 70% of custom duty was on essential items. Essential items is allowable. So we'll go here, essential items. Now we are told that this 2,250 that we call disallowable, some part of it is allowable. So we are going to go 0.7 times 2,250. So part of this amount here that we disallowed, some of them are allowed. So we are going to do it now. 2,250 times 0.7, that gives us 1,575. 1,575. And that's for essential items. So we have done this. Of course, this means 70% 70% of 250,000. That is what it means here. So we are done with the additional information. Now we'll now go and pick the items here, non-productive rents. So we'll take it, non-productive rents. How much is that? 11, 110, 420. 110, 420. Okay. The next one happens to be intangible drilling costs, 439. So 439,000. That is intangible drilling costs. That's allowable. Then the next one will be, oh, we have an issue here. This custom duty is not this here. So we have made a mistake. So this 70% is not on this. This is custom duty on plant and storage, but this is a custom duty alone. So is this custom duty that we should have taken? 53,200. So it is on 53,200. So we'll go back and do this. That's why it's good to look at the question again. 53,200. So we are adjusting this. Sorry for that omission. 53,200. So let's do that. 53,200 multiplied by 0.7. That gives us 37,240. 37,240. So that's corrected. If you were in the exam, all you would have just done is just to roll out this line and do it right under here. All right, so we have done custom duty, salaries and personnel costs, 280,500. 280,500. 280,500. So it's salary and personnel costs. All right, the next one is interest paid. No additional information was given about it. 5410. 5410. So that's 5410. Writing it well. 5410. Interest paid. Okay. The next one is royalty on oil exported. 110,600. 110,600. So this is royalty on export sales. Of course, the next one should be royalty on local sales. So let's see the figure. Royalty on local sales is 41,200. 41,200, 41,200. Then of course, stamp duty is not allowable because, okay, stamp duty is allowable. This is just custom duty that was not allowable. Stamp duty here is allowable. Stamp duty 1,050. 1,050. The next one is donations. Donations is not allowable. So we're not taking this. Then transportation 7270. 7270. This is transportation. We just have to know all the allowables and use them. Admin and general expenses 340,200. Admin and general expenses. Then the next one, bad debts. There's no mention about it in the additional information, so we want to assume it's specific bad debts, 66,000. Of course, we want to assume it's specific. Then we have pension contribution. Pension contribution is 21,000. So that's 21,000. So let's see if we have done everything in it. Of course, we know that depreciation has been removed. We've done that. So what is remaining here is capital allowances and this storage tab. These are the only things that is included that is not done. So now that we've done, we are going to look for the total so far here. So let's do that together. My calculator on screen is not available, so we will use, I want you to follow me as I do it. 418 750 plus 29 920 plus 37 240 plus 110 420 plus 439,000 plus 280 500, 280 500 plus 50 410, 50 410 plus 110 600 plus 41 200 plus 1050 plus 72 070 plus 340 200 plus 66,000 plus 21,000, and I'm getting 2 million 018, let me write the 8 well, 2,018,360. Now, this is all your accessible profit, your allowable deduction, excluding tertiary education tax. So, of course, you have to bring your tertiary education tax here, which is going to be by workings 1. When we do that, we will come here and we will now have total allowable deductions. And your total allowable deductions will occupy here. And when we deduct it from the gross, then we are going to be having accessible profits, which is the A part of the question that was told to get 7 marks. So that's going to be the accessible part of the question. That's A, the accessible profits. Then we are going to less capital allowance. That will be by workings 2. So your capital allowance will be here. Then it will be chargeable profits. That's going to be the B part, which will take us like how many marks? 3 marks. Then your chargeable tax, which is going to be your C, is going to be 85% of whatever you get as your chargeable profits. That will be your chargeable tax. And that's all. Now, the reason why I'm setting this template here is for me to come down here and do my workings. So I'll come here and say this is workings. So my workings number 1 is tertiary education tax. Now, how do I get my tertiary education tax? So I will have my gross income. Now my gross income happens to be, I'll write it down here, 3,452,160. 3,452,160. So I'm going to put it down here. 3,452,160. Now I'm going to less other allowable expenses. Now, this other allowable expenses here happen to be 2,018,360. And I'll say 2,018,360. Now, when I less it here, I'm getting 1,433,800. So this is accessible profits 102%. So this is assessable profit 102%. Therefore, TET, which is 2 over 102 times 1,433,800. So whatever I get here, so I'll say multiplied by 2 divided by, sorry, multiplied by 2 divided by 102. So I'm getting 28, 28,114. 28,114. So I'm going to come here and I'll change my marker here. 28,114. So 28,114. If I add it to 2,018,360, I have 2,046,474. So if I had to remove this figure, from 3,452,160, I will be getting a assessable profit of 1,405,686. That's it. Now, if you want to check if your assessable profit is correct, test it with tertiary education tax. Look for 2% of this. So that means this figure multiplied by 2 divided by 100. And I'm getting 28,114. That shows me that my tertiary education is correct. My assessable profit is correct. Now we're going to look at capital allowance. So workings number 2 is capital allowance. Capital allowance. So I will say annual allowance. How much is our annual allowance here? The question says here that capital allowances were agreed at 133,000. So I'll say 133,000. Petroleum investment allowance. Petroleum investment allowance. Of course, this is plant and storage tank acquired and used during the year. That year is 2016. So 2016 is the year. So it means that the capital allowance on this plant and storage tank was inclusive here. We don't need to go and calculate it again. They have already told us that it is 155 meters deep. Now that is what we use to calculate the PIA. 155 meters deep is how many percentage? Now we mentioned that offshore, no, sorry, onshore, which is land, is 5%. Onshore, no, offshore from 0 to 100 is 10%. From 100 to 200 is 15%. So it means this is PIA 15%. So that's what we are going to do here. It's going to be 15% of what is the cost of the storage tank acquired during the year? 80,000. So now we have used this, and now we are using this 80,000. So it should be 80,000. So let's look for 15% of 80,000. So this is like 0.15 times 80,000. That is 12,000. So we're going to look at 12,000 here. And if you look at it now, every figure has been taken care of. Every figure has been taken care of. So all we need to do now is to add 12,000 to 133,000. That gives us 145,000. So that is 145,000. So this is capital allowance. This is A. So this is the first part. And I'll say restricted to, the restriction is 85% of accessible profits. 85% of accessible profits, which is something as 85% times, what's our accessible profit here? Accessible profit is 1,433,800. So 1,433,800. So when we find 85% of it, which is 0.85, we have 1,218,730. Now we are going to less 170% of PIA, which is like 170% of PIA happens to be A of 12,000. 12,000. So we are going to do 1.7 times 12,000. That's 20,400. So this is 20,400. Of course, we are lessing it. So when we less it from 1 to 1,8,730, it means we are getting 1,198,330. So this is capital allowance B. And I'll say choose the lower of A and B. So what's the lower here? 145,000. So our capital allowance here is 145,000. So that's what we are taking, 145,000. $145,000. So when we take away 1405,686 minus 145,000. That gives us chargeable profits of 1,260,686. And that's the chargeable profit B. And your chargeable tax is 85% of 1,260,686. We'll now look for 85% of it. That's 0.85. That gives us 1,071,583. Now that's the end of this question. That's the end of this question that is 15 mark. It's actually 11 mark because the A part has 4 marks. Okay, the A part has 4 marks. This is related to theory part, which you will need to consult your notes. You're handling the technical part, which is the calculation part. So we've done this, and this has been taken care of. All right, let's look at our question trend. We've done May 2018 question 5. May 2018 question 5 has been treated. So let's mark it. This has been done. All right. Let's see a question number 4 question. May 2015 question number 3 and 4. Let's see what is May 2015 question number 3 and 4. Let's see how it goes. In May 2015, May 20, oh, it's November 2015. I'll need to close this. November 2015. November 2015, question number 3 and 4. So let's look for all right, so let's go straight. Question number 3 and 4. Is it? 3 4. Let's peruse it and then see. Now this is definition. All right, so this is another one. All right, let's see if we can do any of them or both of them. All right, so let's see. November 2015, um, question number 3B. So let's go. So this is ICAM past question, November 2015, question 3B. All right, so we are looking at SSV Limited engaged a firm of tax consultants, KMK and Associates, to compute its petroleum profits tax payable for the year ended 31st December 2014. So we say the year of assessment is 2014, and we usually do our 2014 minus 4, which is like 2010, and I would say that is for 19%. If you are doing capital allowance, if there are assets purchased up to that year. Okay, so now the petroleum profit tax was computed at 680 after the following deductions have been made. So this was the things that were computed. They deducted royalties on domestic sales, custom duties on plants and machinery, capital allowance brought forward, capital allowance agreed for the year, agreed loss. Additional information is relevant. We have MO credits, royalty on export sales, other income, they're all here. Tangible drilling costs capitalized, intangible expenses, non-productive rent, additional asset for offshore operations. Okay, additional assets for offshore operations. So the fact that I see MOU credits, I know this is supposed to be PSC. And now they didn't tell you, they told us offshore, they didn't tell you the depths. They didn't tell you the depths. So it means that this thing we are doing here is supposed to be for JV. We are not doing this. And so the capital allowance, of course, is going to be 50%. Investment allowance, even the capital allowance is going to be 50%. And this is tangible drilling expenses capitalized. It's going to form part of your capital allowance expenditure, your your qualifying capital expenditure. All right, so what do we do? They said these are the things that were um, deducted from after getting your petroleum profit tax. So what are we asked to do? Compute the petroleum profits. Compute the petroleum profits. Now, not the tax. Petroleum profits. So SSB Nigeria Limited. SSB Nigeria Limited. Computation of petroleum profits for year of assessment 2014. Okay, so we were given, this is the profits that was declared, 680 million. So we'll start with that. Profits as per account, 680 million. So this is 680 All right. Now, before getting these profits, they have deducted royalty on domestic sales. Is it an allowable deduction? Yes. So we are going to be adding back only disallowable. We are going to be adding back only disallowable. Add backs. So let's do add backs. We might add back disallowable and other things. We are not going to add back domestic sales. We are going to add back custom duty on plants and machinery. We are going to add back custom duty on plants and machinery. So we're going to add it back 160 million. 160 million. Now we are going to say custom duty on P and E. P and E. So that's it. Then all these capital allowances, they are not bad, but we are going to be adding them back. The reason why we are adding them back is we want to know our accessible profits. We cannot know our accessible profits. Our accessible profits would have been known first before we remove capital allowance. We need to know our accessible profits. So we are going to be adding this capital allowance brought forward. That's why you didn't see me say add back disallowable. We are just saying add backs. So we are basically going to add everything except royalty on domestic sales. Capital allowance brought forward 40 million. Capital allowance brought forward 40 million. We are adding them back. We are still going to use them again. Capital allowance for the year 90 million. Capital allowance for the year 90 million. We are adding them back and we'll still use it for the year 90 million. Then we also have agreed loss brought forward. We are going to add it back 100 million. Loss brought forward 100 million. So now, what are we having here when we add all of these? Let's add them together. 680 plus 160 plus 40 plus 90 plus 100. And what we get here is 1070. Now, after adding all of these, we will now say less allowable. Less other allowable. Less other allowable expenses. Okay. Okay, I should have added back, sorry, I should have added back this I should have added back this royalty on domestic sales so that I will get my gross income. sort of. I should have added it. So let me add it back now. Let me find a way and fix it here. Royalty on domestic sales. Domestic sales. Let me add it here. And that's 100 million. 100. So the only thing I'm going to do here is just to make here 1. Okay. All right. So less allowable expenses. So this is like gross income. Now less allowable expenses. So it's not going to be other allowable expenses. So less allowable expenses. So we'll start with those ones we added back. Royalty on domestic sales. Of course, that's 100 million. Then we also have, that's the only thing we are lessing from here for now. Then we have, so that means we've used this one twice. We have royalty on export sales, 200 million. Royalty on exports, 200 million. So that means we have used this. Other incomes. So we'll not say, oh, oh, sorry. We'll come back to this. We need to be very, very careful. This is not yet our gross income. This is not yet our gross income. Other incomes. We have transportation of crude oil. This is not part of our income. Disposal of fixed assets. It's not petroleum. Then others. We are taking just these orders. We are taking these orders. Let's say other income, orders. $20 million. So it's going to be 20 million. When you add it now, it's going to be 190. So there's no other income here to surprise us. So we've taken this. So our gross income now is going to read this. Gross income is going to be this. So now we can now less allowable. expenses. I would say the first one is royalty on domestic sales. I would say it's 100 million, which we've written before. Royalty on exports, we say it was 200 million. That's fine. Okay. Then we have the next one. We will now come here to intangible expenses, 100 million. Intangible expenses, 100 million. Then the next one will be non-productive rent, 10 million. Non-productive rent, 10 million. What else do we have? This is additional assets. This is capital expenditure. Okay. There is no other thing here to be added back, to be deducted. These are capital allowances. So, what do we have? When we total this, 200 plus 200, 410. So this is 410. Then, of course, your tertiary education tax will be 2 over 102 multiplied by 1 million, 1 billion, 190 million. Let me do it here. 2 over 102 times 1 billion, 190 million minus 410 million. So I'm going to claim this one here. So this is your workings for your tertiary education tax. So what I will do now is 1 billion, 190 million minus 410 million. What am I doing? Okay, let me do something. That will give me 780 million. Now multiply by 2 divided by 102. That will give me 15 million. So that will give me 15 million 294,118. All right. I'm going to add them together. 410 plus 15 294,118. of course. So it's going to give me 425 294 118. So when I minus this from 119, that gives me 764. 764, 705, 882. Now that's going to be my adjusted profits. I'll say adjusted stroke accessible profits. All right. Then what will happen is I will less loss, agreed loss, agreed loss. My agreed loss was here, 100 million. So I'm going to less 100 million. When I less this will give me 6664. So that's 664,705,882. So this is my accessible profits that I will be using for capital allowance. This is the one I'll be using for capital allowance. So when I say 85% of accessible profit is going to be this, then I will be doing my capital allowance. Capital allowance brought forward. Of course, we have our capital allowances brought forward here. Capital allowance is 40 million. Capital allowance brought forward is 40 million. Capital allowance for year. Capital allowance for the year is 90 million. So you have been told that these are the capital allowances for the year. So there will be no need for you to start finding capital allowance on this and capital allowances on this. So all you now do is your investment tax credits. So when we do your capital allowance, you will less your capital allowance. So your capital allowance here is going to give you 130. So that's going to give you 130 million. So when you remove 130, you are getting, what am I doing? 664 705,882 minus 130. I'm getting 534. 534, 705,882. Then you are going to be less investment tax credits. Your investment tax credits is going to be the 50% of all of these that were done here. So it's going to be 50% of, you have this as 120 million plus 30 million. 120M plus 30M. So 120 plus 30, which is 150, multiplied by 0.5, which is 75M. So you come here, 75 million. That's your 3, okay, that's your 534, 534, 705, 882 minus 75 million. That gives us 459. So this should be your 459, 705, 882. So this is supposed to be your chargeable profits. So this is your chargeable profits. So what do you do? The next thing to do here is your chargeable tax. Your chargeable tax is going to be 50% of 459, 705, 882. So this is a PLC company. That gives you 229,852,941. Then you're going to less your MOU credits from it, 46 million. So less MOU credits, 46 million. So we are going to less 46. So you have 183, 852, 941. So this will be your PPT due. So this is going to be your tax due. That is going to be your tax due. So you see, you computed from 680 million tax, and now you are paying 183 million as your tax due. So you see why it was helpful they consulted the associates, the company, to calculate their tax, because When the company tried to do theirs, this is what they did. And they built up from what the company did, they repaired the damage, and they got 185. All right, so we have looked at question number 3. Question number 4. We are asked to find everything here. Let's see how we can do that in a very short while. So let's see how we can do this here now. So this is still going to be November. So we've done this question number 3. So we are now doing question number 4. November 2015, question 4. I can. The name of the company here is Toloju Petroleum Limited. Okay, so we are looking at December 31, 2012. So we are looking at petroleum profit tax for year of assessment 2012. Okay, so it means we are going to do something here, and it's quite likely we are going to put 3 zeros. Be on the safe side and put 3 zeros. Now, there is no figure that was written anywhere, so we'll be reading and be putting all our things in their proper place. Toloju Petroleum Limited was incorporated in 1992 and was involved in winning and obtaining chargeable oil for its own account by drilling, mining, and extracting chargeable oil. The managing director was confused on how chargeable tax was computed on the operations of the company during the accounting year ended 31 December 2012. Considering the profit as per the financial statements, he could not ascertain the basis of the computation of assessable profit and chargeable profits. Now, the company sold, so we'll start with income. So we'll say income. So we'll say exports. So when I say exports, the company sold 330 barrels. So we start with the number of barrels, 30,000 barrels in the international markets. So we've used this 30,000 barrels, while 15 barrels were sold in the domestic markets. The posted price was $25. So come here. Okay, let me use it. Let me do it here. 30,000 times 25 multiplied by the exchange is 156. 156. So let's do it now. Remember, I will remove the three zeros. So instead of using 30,000, I will say 30 times 25 times 156. And I have 117. That's fine. Then I have my local. How many barrels was sold locally? 15,000 barrels. So as I'm doing it, I'm marking, I'm writing 15,000. What's the posted price? 1,500. 1,500. So I will say 15 times 1,500. So that will give me 22,500. I think I should put everything since this is not that much. Let me put everything. So this will be 22,500. So it means I'm going to remove these three zeros I put down here. I'm going to remove them. All right. So these are my sales. Before I reach further, let me see if there are other sales. There are no sales here. So compute the accessible parts of the company, showing clearly the physical value of oil. Physical value of oil is what we just calculated now. Okay, physical value of oil sold. So physical value of oil sold will be 139,500. Now there are no other income. Other income. So your gross income is 139,500. So this is your gross income. Okay, so we will now need to less allowable deductions. So what are those deductions we are going to be lessing? The company incurred 5 million on ouch. Other incomes received were 2.5 million from net interest on bank placements. We are going to rework the other income. So it's good that I cut it in time. Other income. So we come here. 2.5 million from interest on bank placements. 2.5 million from interest on bank placements. 2.5 million. So interest, we have 2.5 million dividends. And now we are told dividends is net, 3 million net. We have to make it gross. To make it gross is going to be 100 over 90 times 3M. So 3 million times 100 divided by 90. So that will give me 3 million 333 When you add them together, you are having 5,833,333. Then you add all of these together plus 3,333,333, okay, sorry, 5,833,333 plus 139,500,000. That gives us 145,333,333. Then you will less Frank's investment income dividends. You have to less it. So that's going to be 3,333,333. You're going to less it. So I'll say minus 3,333,333. That will give me 142 million. So my gross income is 142 million. So this is my gross income, 142 million. So we had to convert the dividends net into gross so that we'll have the total income from all sources. Then we'll still remove the dividends income, which is a frank investment income. Just as we added it, we remove it. So that's it. Your gross income sorted out. Then we will less allowable deductions. So what's the first thing we're going to less? So it means we have treated this. We have treated this. So this is done. The company incurred 5 million on administrative and operational expenses. Admin and operational expense. It says 5 million, right? So done this. The sum of 4.5 million royalty on exported sales. 4.5. So this is royalty on export sales. Then, while customs and other duties, customs and other duties. Now, because they put other duties, okay, before we come down, royalty on crude oil sold was 1 million. Royalty on crude on local sales Royalty on local sales 1 million. Royalty on local sales. Now, the custom duties, we have always been disallowing it. We have always been disallowing it. So we are going to disallow it this time. And they said 0.5 was incurred on intangible drilling. Intangible drilling costs. Drilling cost 0.5 million, which is 500,000. Right? Capitalized expenditure. So all these are for capital allowances. So we are going to leave that for now and focus on allowable expenditures. So we'll come down here and total this figure. And what do we have? We have 5 million plus 4.5 million plus 1 million plus 500,000, which is 11 million. 11 million. So here, 11 million. We are now going to get our TET. Our TET should be 2 over 102 multiplied by 142M minus 11M. 142M minus 11M. So 142 minus 11 give us 131M. We'll now find 2 divided by 102. So that will give us 2,568,627. Okay. Then when we add this to this, it should give us 13,568,627. Okay. 142 million minus this other figure we have here, which is 13,568,627. It gives us 128, 431, 373. So that's going to be our accessible profits. The accessible profit is here. Then we are going to do our capital allowance. Anything we have as our capital allowance will come here. Then it will be our chargeable profits. Of course, we are going to calculate our chargeable tax. Say 85% of chargeable profits. That's going to be this here. So we'll now go to workings here. Let's say workings one to do capital allowance. So I have my workings here. One, capital allowance. Now, what do we have about capital allowance? They said capitalized expenditure for 2012 were, so these are the things that were done onshore, offshore activities. This is the capitalized expenditure, 7 million plus 5 million. The company purchased qualifying expenditure in the sum of 15 million to improve its property, plant, and equipment, while the expenditure written down value 1% retention were 4 million, 3 million. So what we're going to do here is this is 2012, the year in which we are taking. When we minus 4 from it, so we have 2012 minus 4 is going to give us 28. 28. So in 28, we'll take 19%. In 28, we'll take 19%. So capital expenditure. So what we'll do is annual allowance. We'll now say qualifying capital expenditure 28 was how much? 4 million. 4 million. So you say 19% of 4 million. 4 million times 19%, that will give you 760, 760,000. Then you have qualifying capital expenditure 2009. So it's going to be 3 million for 2009, 3 million. So that will be 20% of 3 million. 3 million times 0.2, that's 600,000. Okay, we're done with this. Then the capitalized expenditure for 2012 were this and this onshore, offshore activities respectively. And we are not told this is going to be this is a joint venture, yes. So expenditure, let's say qualifying capital expenditure 2012, we have 20% times, we have 7 million and 5 million. So you say 7M plus 5M. So 7 plus 5 gives you 12 times 0.2, that's 2.4 million. 20% of 12 million is 2.4 million. Of course, so that's 2,400. So that's it. And the company purchased qualifying expenditure in the sum of 15 million to improve its property, plant, and equipment. 15, another 15 million is also going to come here. QCE 2012 again, 20% times 15M. 20% of 15 is 3 million. So all these are annual allowances. So we have, let's see if we've captured all of them. So we've captured this 15 million, yes. All right. We have 760 plus 600 plus 24 plus 3,000. That's 6,760,000. 6,760,000. All right. Then our PIA, we have PIA, which is plant and machinery. Plant and machinery. Plant and machinery should be onshore. So I would say onshore. So that's going to be 5% times. What are the things that are onshore? We have onshore is 7 million plus 15 million. 7 million plus 15 million. How much would that give me? 7 plus 15, that's 22. Find 5%. That will give me 1.1 million. So I'll put 1,100,000. Then we have offshore. Now, we were not given the depth. We were not given the depth. Now, you can decide to assume which depth that you can use. So you can decide to use between 0 to 100 or 100 to 200. That is what I want to use now. I will say assumed to be 100 to 200 meters. Assumed. Assumed. So that is going to be 15% multiplied by 5 million. Another student can decide to take 10%. You need to state your assumption. So I take 5 million times 0.15, which is 750. Now if I add 750, I have 1,850,000. So this is 1,850,000. So this 1,850,000 is my PIA. So I have 6,760 plus 1,850 So that is 8,610,000. 8,610,000. So that's my capital allowance. So this is my capital allowance. So this is the A part, and I'll say restricted to 85% accessible profits. So which is going to be 85% multiplied by what's our accessible profit the other time. So that's 128, 431, 373. What a mouthful. I'll take them here. 128, 431, 373. I'm going to be looking for 85%. So that gives me 109, 166, 667. Then I'm going to less 170% PIA. So that's going to be like 170% of 1,850,000. 1,850,000. So let's look for that. 1.7 times 1,850,000. That gives me 3,145,000. 3,145,000. So when I less it from 109, 166, 667, I am getting 106, 021, 667. So that's my capital allowance B. And I'm told to choose the lower of A and B. And so the lower, this is 106 million, and this is 8 million. I'm getting 8,610,000. 8,610,000. So this is what I'm going to use as my capital allowance. 8,610,000. 8,610,000. So when I remove it from my accessible profit of 128, 431, 373 minus 8,610,000, I'm getting 119, 119, 82, 821, 373. All right. Now I'm going to be looking for 85% of this same figure. So multiplied by 0.85, and I'm having 101, 848, 167. So that's my chargeable tax. And that answers your fiscal value of chargeable oil, total profits, accessible and chargeable profits. I even went and did more. I did more. This is where my answer should have ended, and I gave them chargeable tax. That's fine. This is just for tutorial sake. They were not asking you to do chargeable tax, but you can as well do it. Some might just give you an extra mark for doing that. Some might just decide that this is not part of the requirements, but it's just one line and nothing is going to happen if you do that. So we have succeeded in answering this particular question. All right, so we have now come to the end of today's class. We have attempted to solve a number of questions in the petroleum profit tax series. In our next class, we are going to look at a revision of all that we have done. And if there is time, we may solve a question on petroleum profit tax. So we might first of all solve one question on petroleum profit tax and perhaps do a revision of all the key things that we have done. Not everything, a key thing of what we have done. So come prepared for that final class so that you can be adequately prepared for your exams. So once again, I say thank you for coming to class and do well to review all these videos that you'll be getting. So until I come your way again, this is good night from me.